Economic containment through tech. Restrictions. Energy warfare through strategic. Sanctions. Global trade. Reshuffling. Rising defense budgets worldwide. Persistent. Fiscal expansion in the US. These aren't headlines. These are structural forces. The system is being reshaped in real time. And gold is pricing that in. Now here's what this means for you. First, don't just chase performance. Follow the signals. Gold is not merely an inflation hedge. It's now a hedge on geoeconomic instability. When governments use economic tools to pressure rivals, that introduces second-order consequences. Currency volatility, supply chain reshaping, and eventually inflation that the CPI doesn't catch. Second, the dollar is strong, but it's vulnerable. Its strength today is a vote of no confidence in alternatives. But if those alternatives get built, the shift will be fast. Watch for bilateral trade deals. Watch for energy settled outside the dollar. Watch for digital payment rails designed to circumvent SWIFT. Third, equities are ignoring risk. The headline indices are climbing, but the risks are stacking underneath. Look at margins. Look at forward guidance. Look at capex reductions. The weight is building. So what do? You position. That means reassessing your asset mix. That means increasing exposure to hard assets. Gold, commodities, inflation-linked securities. It means thinking about geography. Where are your exposures? Are you reliant on markets with escalating political risk? It means thinking about timelines. Is your strategy built for 2021-style reflation or for 2025-style fragmentation? This isn't about panic. It's about clarity. The rules are changing. That doesn't mean you retreat. It means you adapt, because the winners in this cycle won't be the fastest traders. They'll be the clearest thinkers. We don't bet, we anticipate, and gold just told you what's coming next. If you want more stories like this, clear, verified, and unfiltered, subscribe now and stay one step ahead of everyone. Gold just spiked over 1% in a single day, after its biggest drop in 5 years. This after hitting an all-time high of $4,081 per ounce. And now it's back in motion. That's not noise. That's signal. At the same time, the US government sanctioned Rosneft and Lukoil, Russia's two largest oil giants. Not over oil directly, but over Ukraine. This matters. These aren't symbolic moves. This cuts into global oil flows, energy financing, and currency arrangements tied to oil exports. And while that grabbed headlines, something quieter slipped under the radar. Washington is preparing a plan to severely restrict software exports to China. Not hardware, software. That means strategic code, operating systems, enterprise tools. The digital blood vessels of global commerce. Gold reacted fast because markets aren't just digesting price data. They're tracking power moves. And right now, they're seeing the structure of risk evolve. Before anything else, if you want the story behind the headlines, direct, real, and without spin, subscribe and never miss a thing. This isn't what Wall Street told you. Wall Street told you gold sold off because traders were locking in profits, that after a record run, the metal was due for a breather. Reuters said renewed geopolitical risks brought the bounce. CNBC pointed to inflation data and expected rate cuts from the Fed as the catalyst. A tidy narrative. Gold dipped, buyers stepped in, and tension returned. Nothing structural, just positioning, but that's only the surface. Beneath the headlines, something bigger is moving. Not short-term data points, not trader sentiment, but policy intent. This isn't about hedging tomorrow's CPI print. This is about governments reshaping the global game board. The invisible lever here is economic warfare. And this isn't a theory, it's unfolding in real time. The US isn't reacting to Russia and China. It's repositioning assertively, strategically, with moves that say we control the flow. Sanctioning Rosneft and Lukoil doesn't just hurt Russian revenues. It squeezes their access to the dollar system. It complicates shipping logistics. It sends signals to third-party nations buying Russian oil. It puts pressure on the ruble indirectly. But the most critical piece, it reinforces dollar dominance by weaponizing access to it. At the same time, limiting software exports to China isn't a tech regulation. It's a choke point play. It's about halting China's internal innovation cycle. It tells Chinese firms, you may build chips, but we can still deny you the instructions. We can cut off the operating system, the compiler, the enterprise backend. That's not protectionism, that's digital containment. Together, these moves form a pattern, a coordinated economic siege doctrine. Not a Cold War, a financial war, one that uses policy instead of tanks, currency corridors instead of trenches. And the market sees it. Gold sees it first. This isn't about fear. This is about structure. The rules of engagement are shifting. When sanctions become surgical tools and software becomes a lever of statecraft, the old risk frameworks collapse. Now let's talk mechanics. Gold doesn't just move because inflation is hot or cold. It moves because trust fluctuates. It moves because investors watch the plumbing beneath the market, the flow of reserves, the credibility of sovereigns, the stability of trade routes. Think of gold like a pressure gauge. It doesn't just react to temperature, it reacts to stress. Monetary stress, strategic stress, structural stress. When the US signals that it will actively target adversaries through economic choke points, that's added pressure. When oil supply chains shift, when tech stacks become battlegrounds, when sanctions touch strategic assets, the gauge rises, and here's what most don't see. This isn't about today's news. It's about tomorrow's structure. Gold isn't reacting to volatility. It's reacting to credibility risk. Imagine a seesaw. On one end, you've got the traditional drivers, Fed rate cuts, dollar strength, inflation outlook. On the other end, you've got geopolitical fractures, supply chain instability, and weaponized finance. Traders are still watching the weight on one side. But the fulcrum just shifted. The pivot point isn't monetary policy anymore. It's systemic resilience. When Rosneft is sanctioned, that's not just a hit to Russia. It's a message to any country relying on non-aligned supply chains. When software restrictions are floated, that's not a threat to China's current production. It's a constraint on their future scalability, and when both moves happen in the same week, that's not coincidence. That's choreography. Markets noticed. Gold noticed first, because gold is the ultimate hedge against narrative collapse, against illusion of control. When investors no longer believe the system is playing by consistent rules, they don't go to bonds. They go to something ruleless, something borderless. Something liquid, scarce, and apolitical. That's why gold surged. Not because CPI might show 3.1%, but because the underlying trust architecture is wobbling. Gold didn't just rebound, it pivoted. After dropping sharply earlier in the week, gold reversed direction, with spot prices rising over 1% and futures gaining 2%. This wasn't a relief rally. It was something else. A strategic repositioning. Investors weren't chasing momentum. They were responding to a deeper shift, because this wasn't just about buying the dip. This was a hedge against structural instability, a recalibration. It came after gold briefly dipped to a 2-week low in what seemed like a normal pullback. But under the surface, something broke. The market felt it before the headlines could explain it. And gold moved first. Start with energy. The US didn't just sanction random Russian firms. It sanctioned Rosneft and Lukoil, the two biggest pillars of Russia's oil export economy. These aren't symbolic targets. These are systemic arteries. They touch pipelines, shipping, refining, contracts. The impact isn't limited to Russia. It creates ripple effects through oil futures, shipping insurance, and global energy pricing. This matters because energy isn't priced in a vacuum. It's priced in dollars. And when energy flows are disrupted, and those disruptions are politically driven, currency markets react. Investors start to hedge against price spikes, against trade instability, against future retaliations. Now look at the other move, Washington preparing sweeping restrictions on software exports to China. This isn't about stopping gaming software or niche tech. It's about enterprise infrastructure. Compilers, cloud platforms, operating systems, the tools that make digital economies run. When access to that kind of infrastructure is politicized, it becomes a weapon. It says, you can build the hardware, but we can still deny you the code. Gold responded. Because gold doesn't just move on rate expectations. It moves on systemic stress. And these two actions, energy sanctions and tech restrictions, aren't random. They're a coordinated signal that economic instruments are now primary tools of statecraft. Gold functions as a barometer, not just of inflation, but of global trust, of structural confidence. When that trust breaks down, when markets see nations using economic access as leverage, gold surges, not because it's yielding anything, but because it exists outside the system. Look at the dollar next. Normally, when the dollar strengthens, gold pulls back. But now, the relationship is more complex. The dollar is rising, yes, but not on fundamental strength. It's rising because everything else is more fragile. That's not bullish. That's defensive. Investors are holding dollars the way they hold umbrellas in a storm. Not because they expect sunshine, but because they see the clouds. And in that kind of environment, gold can rise with the dollar. Because the dollar isn't rising on growth, it's rising on risk. And gold is the other side of that risk equation. The more aggressive the US becomes with economic tools, whether against Russia or China, the more fragile the dollar's reserve position becomes long-term. Other nations watch. They respond. They hedge. Now let's bring equities into the picture. Stocks are rising. Why? Because markets expect the Fed to cut. That expectation is priced in. Traders see slowing inflation, softening labor numbers, and they're betting on liquidity. But what if the Fed cuts in the middle of rising geopolitical risk? What if the cut comes during a time when energy prices are spiking and global trade is fragmenting? That's not stimulus. That's confusion. That's how you trigger stagflation. Lower rates, higher input costs, weaker consumer demand. Corporate margins get squeezed. Earnings estimates crumble. Gold is warning us about that now. The equity rally looks strong on paper, but underneath volumes are thinning. Breadth is narrow. The moves are concentrated in defensive sectors and tech. That's not confidence. That's rotation. The biggest funds aren't chasing highs. They're buying protection. That's what the gold rebound reflects. And we're not just talking about US moves. Globally, central banks have been buying gold at record pace. Why? Because they're diversifying away from dollars. They see the shift too. The more the dollar is used as a weapon, the more other nations want alternatives. Gold for them is not a trade. It's an insurance policy. Now let's talk about volatility. When investors get nervous, they hedge. They rotate out of growth. They move into hard assets, commodities, cash, metals. They extend duration in bonds, but only selectively. Right now, with long yields still elevated and inflation not fully dead, gold becomes the bridge asset. The one that can move in both directions, risk on and risk off. That's why the market is recalibrating. What you saw in gold was not random. It wasn't noise. It was the system recalibrating to new inputs. Inputs like